Thank you for joining us today on our special webinar with our friends at PwC Malaysia. It's really heartening to note the response that we've received for this particular session. We've got close to 400 people registered for this from all over. So we've got representation from South America, Europe, Asia, of course, Australasia. So thank you for your interest. It's really, really heartening. And I just wanted to say a few things before we go into the presentation. First and foremost, a lot of people don't realize that this is actually our 30th year. So Labuan IBFC has been around for 30 years now. Today, 2020 is our 30th anniversary, and we just wanted to really highlight the fact that we've been a long-standing jurisdiction, first and foremost, and the fact that really change is constant. So, I think the title of this webinar today is basically surrounding change, and change is constant, and change isn't necessarily bad. I think one of the things that really has changed the face of international financial centers is the fact that taxation and the transparency in taxation has created a new modus operandi. So really what has happened here is that the old ways of doing business, the old ways of managing global businesses and cross-border trade has changed tremendously because of this push towards transparency and equality, really, in the issue of taxation. And this has created a whole movement in substance. It's created a whole movement in a flight to quality. And this is where I think personally, Labuan has benefited from. For the longest time, we have had a very high standard of regulatory requirements. We have had a very high standard of anti-money laundering laws within Labuan, which is exactly the same as you get onshore in Malaysia. So we have, and so the change in the approach towards taxation and transparency has created a flight to quality, which has benefited us. Suffice to say, it would be amiss of me to not mention the situation we all face ourselves in today in 2020 with this issue of COVID. And really what has happened in that space is that obviously all centers have experienced a slowdown. But having said that, we're still very optimistic about the future, and we're very excited to talk about the future today with our friends from PwC. We will go into the Q&A at the end of this session. But before that, really what we wanted to do and what we always do is kind of create an opportunity for you to have your voice heard, for you to participate in a poll. And really before we go into the first session, what we're going to do is run a poll, and the poll, and maybe our admins here can host up the poll now. The poll reads, do you believe that the global tax landscape will evolve into what is seen as a more equitable system in the next decade? So really this whole transformation of tax, this whole transformation of equity, the idea of equity within tax, and where do you see us in the next 10 years? So please get your clickers on and tell us what you think. We will revisit and we will come up with the results before the panel. There will be also another poll after the presentation before the panel, and please participate. So before I go any further and invite my friends from PwC to do their presentation, let me just introduce our speakers today. So first and foremost, I'd like to thank both Jennifer and Bindo, who've been very, very kind friends to Labuan, and my own personal friends, I have to say. And I've enjoyed friendships with them for a long, long time, and I'd like to thank them for that. But also, the relationship between PwC and Labuan IBFC has been ongoing for many, many years. Jennifer, who is the partner of financial services within PwC Malaysia, is the go-to person for everything Labuan in PwC, and also she is also the Islamic finance tax leader for PwC in Asia. So she has had more than 30 years experience both in Malaysia and in Australia, and is known as one of the ladies in taxation in Malaysia. So thank you, Jennifer, for taking the time to be with us today. We really appreciate it, and we look forward to your presentation later with regards to Labuan and the changes within Labuan. But before that, I'd like to also introduce Bindo, or Aurobindo Punaya, who's Director of Tax, PwC Malaysia. Bindo has had more than 25 years experience in all MNCs related tax, M&E related tax. He's had experience dealing with policy regarding to tax. He is the in-house BEPS expert, I believe, if I'm not mistaken, and has tremendous experience both domestically, internationally, and regionally in this area. So I think the presentation will first start with Bindo talking about the changes in the tax landscape. After that, what will happen is that he will pass it over to Jennifer, who will discuss specific changes within Labuan in response to these global changes. And after that, we'll have a panel discussion about a bit of everything, and hopefully some participation and some questions from you, the audience. So once again, before I pass to Bindo, thank you very much for taking the time to be here with us. We look forward to your participation later. Bindo, would you like to take it on now? And thank you.
Yeah, thank you very much for the kind introduction. Jennifer and I are also very happy to be your good friends and good friends of Labuan IBFC. Yep. And thank you for organizing this webinar. Definitely a great honor for us to be doing it. To the audience itself, thank you very much for signing up for this webinar. As mentioned by Farah, Jennifer and I are from PwC Taxation Services, and we are based in Malaysia. We will be presenting on international tax developments, which have been happening over the last few years, which has impacted on Labuan as well as other financial centers. I will be covering the international tax developments, while Jennifer herself will be covering the impact it's had on Labuan. Now, maybe diving in straight to what's happening internationally. I'm sure many of you know that the OECD has come up with the base erosion profit shifting program. Yeah. Now, this is not something new. This started in 2012. After the global financial crisis in 2008-2009, many of the countries who were impacted by this, including much of the EU and America, as well as many other Asian countries, many of them basically had to come up with stimulus programs as well as bailouts for a lot of their multinationals and for their economies. Now, these bailouts, these stimulus packages and all that impacted their budgets. So a lot of them had budget deficits. And eventually they figured out that they had to close that budget deficit gap. Now, as in any country, including Malaysia, to close a budget deficit gap, one of the biggest things they look at is taxation. Now, when it comes to taxation, they started looking at international tax. They started looking at multinational corporations and how these multinational corporations operated globally. When they were operating globally, these multinationals could be parking profits not in their home jurisdiction, but in other jurisdictions, where at times the tax regime could be more favorable. Now, this is not illegal at all. Yeah? These structures were common, but because of the constraints on the budgets, countries started looking at it more closely. And so the OECD at that point in time decided to launch what is known as the Base Erosion Profit Shifting Project, BEPS. This happened in 2012. Now, the BEPS project had 15 action points. If you look at the screen now, these 15 action points were action point 1, which looked at digital businesses. Action point 2, 3, 4, and 5 were what was known as coherence actions, and these looked at hybrids. Hybrids would include hybrid entities, hybrid instruments. They looked at CFCs, or controlled foreign corporations. They looked at the use of interest to maximize the deductions and in order to lower the tax payable. They looked at harmful tax practices, including incentives, low tax jurisdictions. Action points 6 to 10 were looked at substance actions. This looked at preventing treaty abuse, meaning the use of tax treaties to plan your structures and therefore get the best possible tax rate. They looked at permanent establishments, and they also looked at transfer pricing action points, which are action points 8, 9, and 10. The transparency actions were actions 11 to 13, which is the data on BEPS, tax scheme disclosures, which is effectively that if a tax promoter, a tax consultant, or a company came up with a tax structure, they were required to disclose it to the tax authorities. Some countries already have this in their domestic law, but many countries don't. Action point 13, which is the transfer pricing disclosure, which is also commonly known as CBCR, which I'll touch a bit later. Then you had action points 14 and 15, which were dispute resolution, meaning if there's a dispute between the tax authority and the taxpayer, how was it actually going to be resolved involving different tax authorities and taxpayers. And action point 15 was the multilateral instrument, which I'll also touch a bit later. Now, looking at the timeline itself, as I mentioned, the OECD started the BEPS project in 2012. In 2013, the G20 endorsed the BEPS project, and the OECD released their timeline for the BEPS action plan, this 15 action points which I mentioned earlier. Now, 2014 to 2015, the OECD worked on these 15 action points. Now, the OECD did not work in isolation. They consulted member countries, and they also consulted non-member countries because they realized that the BEPS action plan had to encompass as many jurisdictions as possible in order for it to be successful. So just making use of member countries and not non-member countries would have defeated the purpose of BEPS. In 2015, October of 2015, the OECD released the final reports, all 15 reports. Malaysia, although not a member of the OECD, has even prior to this BEPS action program been very closely involved in discussions at the OECD. Malaysia always sat in the discussions. It had its points of view with respect to tax treaties, transfer pricing, etc. And so Malaysia was actually involved in these discussions as well. And Malaysia made a decision that, yes, it would be part of that. So in 2016, Malaysia implemented CBCR, which is action point 13. And then in 2017, Malaysia joined the OECD Inclusive Framework. Now, the Inclusive Framework effectively tells member countries, as well as non-member countries who join it, that they have to implement a minimum number of action points. They do not have to implement all 15 action points, but there were a minimum number of action points which they had to implement. In 2017, CBCR was also implemented under LABATA. Now, from 2018 to 2020, Malaysia started implementing a number of rules, amending tax incentives, increasing substance requirements, looking at permanent establishments, as well as its tax treaties. I will cover a number of these changes in the coming slides. As I mentioned before, the inclusive framework. Now, the inclusive framework has what is known as the minimum standards. There are 4 minimum standards. These minimum standards are implementing CBCR, right? Now, what is CBCR? CBCR effectively requires multinational companies to provide a report on an annual basis to the tax authorities. This will allow the tax authorities to assess the high-level transfer pricing risk and other BEPS-related risk in order to be able to make a determination whether that multinational needed to be investigated further. Action point, the minimum standard number 2, which is countering harmful tax practices. Now, one of the big issues globally has been the use of tax incentives to attract investments. Now, when using tax incentives to attract investments, countries tend to try and outdo each other. So if one country decreases its tax rate for a certain type of activity to 5%, another country may turn around and say, oh, I'll give you 0%. Right? So in a way, this attracted multinationals to try and move certain activities to countries which offered them the best tax rate possible. The minimum standard number 3 is the prevention of treaty abuse. Now, tax treaties are signed by many countries to prevent double taxation. But what has happened over the years is that companies have been able to use these tax treaties and treaty shop. So they would interpose a jurisdiction before making their investments, and therefore being able to use the benefit of a tax treaty which was not available to the original jurisdiction. So it could be a company based in country A, routing an investment via country B into the ultimate investment destination of country C, rather than going from A to C directly. So this was also seen in a way as a kind of an abuse. Although it was very commonly done, it was seen as a kind of an abuse. And the OECD wanted to actually tighten this up. And of course, the minimum standard number 4 is enhancing dispute resolution. The OECD realized that when they start doing all of this, there are going to be disputes between taxpayers and tax authorities. And so they wanted to make sure there was some kind of a mechanism. There are existing mechanisms, but they wanted to improve the mechanism to make sure that any dispute could be very speedily resolved and therefore not, I would say, impact cross-border businesses as much as possible. Now, CBCR itself. CBCR was one of the first rules which were implemented globally. Action point 13, the OECD wanted this implemented as soon as possible. So in October 2015, the final action reports were released. So many countries in Europe, in Asia, in America, they started implementing CBCR in 2016 itself. Malaysia and some other countries implemented it in 2017. And some other countries, like for example, Hong Kong and I would say some of the other smaller jurisdictions, started introducing them in 2018, 2019, and some of them even introduced it in 2020. But by 2018, the vast majority of countries had already introduced CBCR. Now, what is CBCR? CBCR is effectively something which impacts large multinationals. The rule of thumb is 750 million euros in consolidated revenue. So if you're looking at a group of companies, 750 million euro. In Malaysia, the threshold is 3 billion ringgit. Right? Now, what happens if you're a multinational who has reached this threshold? What you're required to do is file a report. It's basically a standard template. Now, this report, what you will do is put in details of the various jurisdictions you're in, and it would ask you for certain information. This would include related party revenue, unrelated party revenue, taxes paid, and a whole lot of other information which you've got to put in there. And then you also have to put details of each entity which you have in these jurisdictions and the activity being conducted by these entities. Now, once this is done, you have to convert it into an electronic file and file it with your home jurisdiction tax authority. So for example, in Malaysia, the Malaysian headquartered multinational will prepare this, it will convert it to an electronic file, and it will then upload it into a system which has been prepared by the Inland Revenue Board. Same thing happens in countries like Singapore, Indonesia, India, UK, Netherlands, America, Australia, New Zealand. Yeah? As I mentioned, a lot of countries have actually come up with this. So no matter where you're located, if your jurisdiction has this rule, you have to follow it. Now, once you've uploaded it in the system, most of these countries have actually signed a kind of a exchange of information protocol. So what will happen is that if you're a Malaysian multinational, you have filed this report in Malaysia, and you have a subsidiary, say, in India. The Indian tax authorities would be able to access this information from the electronic system. Similarly, if you're an Indian multinational, you would have filed this report in India electronically. And you have a subsidiary in Malaysia, the Malaysian tax authority will be able to access this information as well. So they now, rather than having a narrow view of what you do in their jurisdiction, they have a more holistic, broader view of what you do globally. That gives them a better understanding, a kind of a transparency over multinationals' operations globally. Now, in terms of compliance itself, almost every country has a non-compliance penalty. So if you do not comply with it, there are financial sanctions, even imprisonment. In Malaysia, for example, the financial sanctions are between 20 to 100,000 ringgit and or 6 months imprisonment if convicted. So multinationals impacted by this must file it. Now, what happens if you're a multinational headquartered in Labuan? Labuan has also implemented these rules. So if you're headquartered in Labuan, you must also prepare this CBCR report and file it with the Inland Revenue Board of Malaysia. But if I'm not mistaken, Labuan sanctions are even higher. I think it's about 1 million in penalties, which is higher than actually the Income Tax Act in Malaysia itself. So I guess the Labuan authorities are very much for this, and they want the transparency action to be put in place. And by increasing the penalty, they're making sure that multinationals headquartered in Labuan know that this is something which they're taking seriously and must be adhered to. Now, moving to the next one, harmful tax practices. Now, what about these harmful tax practices? Okay, harmful tax practices, what the OECD has decided is that if you actually want to get an incentive, you must qualify for that incentive. Now, how do you qualify for that incentive, right? They are looking at substantial activity. They want to know whether do you have employees in that jurisdiction, how many employees and what are these employees doing. I can turn around and say that I have 20 employees, but they could be secretarial staff, they could be tea ladies, etc. and all that. Or I could have 5 employees who are highly paid scientists. So that substance in terms of the employees has to be looked at on a case-to-case basis. You also want to look at the investment outlay. How much have you invested in the country? How much are you committing in terms of your investment? And the other is the income from IP exploitation. This is an area where the OECD and many countries have actually looked at with a fine lens. The reason being is that many times IP is developed in a certain country, and when the IP is developed in that country, they then move the IP to another jurisdiction. It could be a low-tax jurisdiction in order to exploit it and capture the income there. So what the OECD wants done is what is known as a nexus approach. You are allowed to get an incentive for that IP. However, when you get an incentive for that IP, what happens is, once you get the incentive for that IP, you must be able to prove that that IP was actually developed in that jurisdiction where you're getting the incentive from. The other thing which is not allowed for incentives is ring fencing. In other words, a jurisdiction states that I will give this incentive for taxpayers who are coming in from outside my jurisdiction, so inward investment. But for my domestic taxpayers, I will not give them that incentive. So in other words, it's protecting its tax base, but allowing another country's tax base to be eroded. So that ring fencing has to be removed. So for example, for many years in Labuan, there was a prohibition of Labuan entities transacting with domestic Malaysian entities. But that prohibition has now been removed. So it is no longer ring fenced. Now, this substance requirements, this is not something which has only impacted jurisdictions in Asia like Labuan, etc. and all that. But almost every country, every jurisdiction, every financial center has been impacted by this. It's everything from Hong Kong to Cyprus, to Cayman Islands, to Barbados, to BVI. They've all had to now change their laws, and they've included things like employees, the level of investment, your annual business spend, your core business activity, decision-making, documentation, physical office. They all want you to actually have a substance in the jurisdiction before you qualify for any incentive or any low tax rate. So this is a global phenomenon. It is not something which is just limited to this part of the world. I would also look at the MLI. Right? Now, the MLI is effectively a kind of a treaty instrument, right? It's an instrument which is signed up by all the countries who are subscribing to this BEPS project. What is the reason for this MLI? Now, tax treaties are generally negotiated on a bilateral basis. Country A negotiates with country B. So for example, Malaysia has 73 tax treaties. Now, if it wants to amend those 73 tax treaties to go out there and counter any of the abuses it perceives to be taking place because of tax treaties, it will take a long time. And we multiply this with all the other countries involved, so it's going to it is not practical for each tax treaty to be amended. So they came up with the MLI. What the MLI does is that countries will decide within the MLI provisions itself what they're going to adopt. There's a minimum amount of things they need to adopt, and they will sign up to it, and they will say which treaties in their network will be covered by the MLI. So once they've done that, another country, which is also part of this, will also have to sign up. So when two countries have signed up or more, the treaties impacted will start changing. So for example, if Malaysia signs it and country B signs it, then the treaty between Malaysia and country B will be amended. However, if country C decides not to sign up to it or has a certain exception to it, the treaty between Malaysia and country C will not be amended. Now, what does this MLI cover? There are certain minimum standards, which is the purpose of the agreement. This is to say that the agreement is for the avoidance of double taxation and not for tax evasion or avoidance. It is to prevent treaty abuse. So they want to include a general anti-abuse provision into the treaty, which is generally what is on the principal purpose test. What is the purpose of that structure? What's the purpose of you using the treaty? And it also wants to update the mutual agreement procedure within the treaty itself in order to, I would say, enhance the dispute resolution. There are certain other optional provisions, including transparent entities. This could be like partnerships, for example. The avoidance of permanent establishments. They want to tighten the permanent establishment definition within the treaties in order to prevent it from being used to avoid taxes. And then they're also looking at corresponding adjustments. Yeah? So effectively, it allows corresponding adjustments to be made to profits of residents in order to mitigate double taxation. Now, the thing here is that when it comes to international taxes, many of these things, I've only scratched the surface here. For things like an MLI, for things like the harmful tax practices, etc., and all that, I could easily spend a whole day talking about it and looking at all the provisions and all that. But I've got 20 minutes here, so I have skimmed the surface of it. But I hope it's given you a good overview of it. Now, what I would like to do at this point in time now is to pass over to my colleague Jennifer, who will now address the impact these changes have had on Labuan and how the tax system in Labuan has actually been amended to conform to global standards. Over to you, Jennifer.
Thank you very much, Bindo. Hi, everyone. So if we actually get into the taxation system in Labuan, what I'll be doing is to share with you the general taxation in Labuan and what are some of the changes that Bindo has mentioned just now. So if you see on your screen there, the Labuan taxation regime in terms of the preferential tax treatment or the incentive that has been given for locating yourself in Labuan and to conduct certain activities in Labuan is that first and foremost, whether you are conducting Labuan business activity. And that has been defined to include Labuan trading or Labuan non-trading. And Labuan trading includes things like banking, insurance, management, licensing types of activities, whereas Labuan non-trading activity includes things like holding of investments in securities, stocks, shares, and properties. Yeah, so that's basically the definition of the types of activities in Labuan. And depending on the activities in Labuan, the preferential tax treatment would be slightly different. Because if you're purely holding investments, for example, in other words, you're a non-trading company, then you are not subject to tax in Labuan. Yeah. Whereas if you're trading, for example, if you're involved in activities such as leasing, banking, insurance, licensing, and all that, then the taxation will be a preferential rate of 3% based on the net profits in your audited accounts. Of course, based on what Bindo has mentioned just now, there is now a need to have substance in Labuan. So this preferential treatment is on the basis that the Labuan companies have met the substance requirement. And I'll go through in the subsequent slides what do I mean by substance in Labuan. Now, if you're a Labuan company and you could actually have activities such as banking, but you may also hold investments, then obviously you are still seen to be conducting trading activities. Yeah. And if you're a Labuan company that does not get into Labuan business activity, then you are taxed at the domestic Malaysian tax system. Currently, that's a tax rate of 24%. Now, what is being taxed at this 3% preferential treatment? So it would be all profits that's in your audited accounts, and it would include things like capital gains because it's part of your net profits. And if, for example, the Labuan company holds properties like land and buildings in Labuan, it was in Malaysia as in like domestic Malaysia or Labuan, which is part of Malaysia, then you would still have to pay the Malaysian real property gains tax on the disposal of property. Now, what's quite unique about Labuan is that it actually does try to promote Islamic finance, and therefore the payment of taxes will include things like payment of zakat. So if you have actually paid zakat, then you can net it off against the tax payable. Yeah, so that's pretty unique compared to a lot of other financial centers. So a whole host of other incentives have been given. So if Labuan companies actually conduct certain activities and there are instruments of transfer relating to certain assets, there is actually no stamp duty, is actually exempted. The sale of shares in Labuan companies would also be exempted from stamp duty. And of course, to try and encourage people to locate themselves in Labuan so that it's easier for Labuan companies to hire people. There have been incentives given to people to locate themselves. For example, 50% exemption for employment income for non-Malaysian, in other words, expatriates. They will have 50% exemption. If you're a Malaysian who wants to go to Labuan to work, then there is that 50% exemption on the housing allowance and Labuan territory allowance. What's important to also note is that Labuan is considered as a designated area and has been also sort of like exempted and not subject to sales and service tax generally. But of course, if it touches anything to do with Malaysia, or if it imports services into the designated area, there is still that service tax applicable. Yeah. Now, if we turn to other sorts of taxation incentives that have been used or provided to sort of facilitate financial types of transactions and activities, you'll find that payments made to Labuan entities from Malaysia generally does not suffer withholding tax. And similarly, Labuan entities that pays out different types of payments, like for example, dividends, royalties, or interest, or technical and management fees, there's also no withholding tax applicable. Yeah, and if let's say the Labuan entity is involved in leasing, then the payment of lease charges from Labuan entities will also not be subjected to withholding tax. So this is really to facilitate a lot of financial transactions that can happen in Labuan, and because of that, we do see companies setting up in Labuan to do quite a lot of different types of financial activities, such as leasing or bond issuance, or even issuances of sukuks, which is the Islamic bonds. So with all these types of incentives, there's another pretty good incentive for global traders. I won't go through in detail, but you can see on your screen there that this is really to promote Labuan for the trading of certain types of products and derivatives, such as petroleum, minerals, agriculture, and chemicals. And that will actually give you 3% of taxes based on your chargeable profits in your audited accounts. And on the right side would be the requirements, like for example, 2 full-time employees, because substance is pretty important nowadays, and the minimum spending in Labuan. Yeah. So with all the incentives, then the question is, what would the substance be required generally in Labuan? So no different from a lot of other jurisdictions that Bindo has mentioned, Labuan also came up with the substance requirements and guidelines, and this was actually effective 1st of January 2019. And it's pretty straightforward in the sense that there are 2 things that you will have to take note of. Firstly, you need to have adequate number of full-time employees in Labuan. And secondly, you need to have adequate amount of annual operating expenditure in Labuan. So depending on the type of business and activities you are involved in, for example, if you're a Labuan fund manager, then the requirement is you need to have 2 employees in Labuan and a minimum expenditure of 100,000 ringgit in Labuan. That converts to about 25,000 US dollar. If, for example, you're a holding company that holds shares, bonds, and other types of investments, then you will need to have 1 employee in Labuan and 20,000 minimum expenditure in Labuan. Yeah, there's a long list of about 20 odd types of activities that the government has actually provided sort of guidance in terms of what the substance requirements are. I have not listed all of these down, obviously, because these are related to a lot of industries such as insurance, banking, trading companies, and all that. So if you're interested, you can actually get it from us or from Labuan IBFC that will give you guidance in terms of what is the substance that's required for you to be in Labuan. Now, once you have this substance, obviously it means that you can enjoy the preferential tax treatment in Labuan. So if you're a trading company, like for example, you're a Labuan fund manager and you do have that 2 employees and minimum expenditure of 100,000, then you will be able to enjoy the 3% preferential tax treatment. Yeah, so it's pretty straightforward in that sense. Now, Labuan company filing is also fairly straightforward, compared to a lot of other jurisdictions. It's basically a form that you have to fill in and a statutory declaration. Or if you're a non-trading company, there's a different form that you have to fill in. It's a 1-pager that you have to fill in, so it's a pretty straightforward process. And normally the deadline to file the Labuan tax return would be 3 months from the start of your financial year, the start of the next calendar financial year. But because of COVID-19 and the lockdown, extension of time has actually been granted till October for this year. Yeah, so tax filing, you still have time because so long as you file by October, you're fine, you're within the deadline. Of course, there are some companies that say that, what about a tax residency? I would like to apply to the tax authorities to get a tax residence certificate because I may be expecting some types of payments from overseas and I would like to access the treaties that Labuan or Malaysia has got. So that again is a process where the company will need to write into our tax authorities in Labuan and provide proof that management and control has been exercised in Malaysia and Labuan. So some examples would be things like having board directors meetings in Labuan to show that control has been made during that meeting. For example, policy making decisions. So you can't just have any normal meetings without making decisions, for example. So it would be better to have some sort of board meetings being held in Labuan and having some sort of key decisions being made. And of course, bank account in Labuan would also be important. Yeah. So this again is a process that is pretty standard. A lot of companies that need to have tax residence certificate will tend to apply to the tax authorities, and normally the tax authorities could take maybe 1 or 2 months to reply with that certificate of tax residency. And important to note that tax residence certificate is given on a yearly basis. So if you need it for the next year, you will need to apply again. So I think that's the end of my presentation. It's a very sort of like broad outline in terms of the Labuan taxation system, the incentives and what is required these days to have substance and to enjoy that preferential tax treatment. But you will find that, we've been sort of like using Labuan and advising clients on Labuan, and it's fairly straightforward in terms of a jurisdiction that's pretty popular.
Thank you, Jennifer. Thank you. Before we go into the panel, thanks, Jennifer, for that overview, but also to run the second poll question. And the second poll question is a little bit more specific vis-a-vis Labuan. Do you think that Labuan IBFC's specified substance approach and cost efficiency will eventually enhance its competitiveness? So I repeat, do you think that Labuan IBFC's specific substance approach, so prescribed, so it's very clear exactly the kind of substance that you need to fulfill in order to enjoy the preferential tax treatment, and the cost efficiency of being in Labuan and Malaysia, Do you think that eventually this will enhance our competitiveness? So yes or no, very simple question. We look forward to the answers and what you think. And we're going now into the panel. So thank you for staying with us. We have more than 220 people at the moment. So thank you for staying with us. Thank you, Jennifer and Bindo, for your presentation. There have been a lot of questions about Labuan. There has been a lot of questions with regards to why. Why has Labuan taken an alternative view, almost as it were, with regards to substance? In the sense that a lot of the other competing jurisdictions have taken an adequate approach, in the sense that when they look at substance, it's about adequacy as opposed to a clear prescribed requirement almost. And that is something that we want to maybe a little bit talk about. But before that, can we discuss a little bit about the international tax landscape? So really, there's a lot to discuss here. First, maybe the overarching international tax landscape, and then after that, going specifically into Labuan and the issues with regards to Labuan and the challenges, the opportunities with regards to Labuan. So, and this is a question for both Bindo and Jennifer. Really, your thoughts on the changes of the international tax landscape as very senior and experienced tax practitioners, and in your time in this space, did you ever think that the issue and concept of equitable tax will ever come to the fore? Either one of you want to take this first? This idea that there is fairness in taxation.
It's an interesting question, and to be honest, I do not believe that equitable taxation is a new concept. I believe the American Revolution, taxation without representation. So equitable taxation has actually been discussed for many centuries. I think today, because the way trade has changed, we become more globalized. By becoming more globalized, we're seeing a lot of multinationals, we are seeing profit shifting, all perfectly legal. And this is simply because countries want to attract investment. So by doing that, what has happened is that we have seen profits soar, tax rates come down, right? And inevitably, there is going to be some pushback against that. And this pushback has happened in the backdrop of the 2008-2009 financial crisis, where it took a larger meaning. And as a result, and today itself, we see globally, we see a kind of what will be, I think if I listen to CNN, etc., BBC and all that, kind of a culture war. Yep. There are two opposing sides, two opposing schools of thoughts. And I believe that by today, equitable taxation has become an issue which has reached the boardroom level. I think companies today want to be seen to be paying their fair share of taxes. Yep. They still have a commitment, a responsibility to their shareholders. So companies, as far as I'm concerned, multinationals over the years have always adhered to the rule of law. And the rule of law at times allow for certain minimization of taxes, but that is actually pushed through by the tax system itself, the tax legislation. And now that tax legislation is being questioned, those tax systems are changing. We will probably see, and as seen by the BEPS project itself, so we'll probably see as tax laws change, the tax rates will increase even more. There would be a tightening of screws, and as a result, the effective tax rate will increase. And what I would hope is that this increase in taxation would probably see that tax collection being channeled towards more useful, I would say everything from social projects to education to health, etc., and all that, which is what I personally believe taxes should be used for.
Thank you. Yeah, me too. Because it has to come, the benefit has to go somewhere tangible. Jennifer, do you want to weigh in on this issue of equitable taxation?
Yeah, I mean, I would mirror what Bindo has said, in the sense that this is not a new issue, and as countries become more globalized in terms of the trading, I would think that it's inevitable what is happening around the world and the OECD requirements as well. Yeah.
No, absolutely. And for us, here at Labuan IBFC, it's been a very interesting time. obviously in the last 10 years that we've been around as the market development arm, we've seen in a more globalized environment, a very regionalized approach towards taxation. So what we've seen is that a lot more regional companies are using regional centers, and because of that, there has been an uptick in the kind of work that we do. Talking about OECD, right? Bindu, I wanted to ask you, as Malaysia is not a member of OECD, how does this pressure, not just Malaysia, I guess, other countries that are not members of the OECD, how does this pressure come to bear and come to the fore of what we are doing in our own tax legislation? Why is that so?
Well, I've received the question a number of times actually. We are not a member of the OECD. Why are we following the OECD's rules? We don't have to follow the OECD's rules. There's nothing which says that OECD rules have to be followed. OECD member countries themselves don't actually have to follow recommendations made by the OECD. But end of the day, by actually sitting in on the consultation and coming up with a new set of rules, if Malaysia does not adopt these rules, it is important to note there's something called peer pressure. So if we decide not to adopt these rules and go our own way and buck the trend, it is very possible we could receive sanctions from these other countries. I'm not talking about economic sanctions, but the sanctions could come in the form of heavier scrutiny in terms of investments coming to Malaysia, in terms of the use of tax treaties, for example. And all this would actually be detrimental to Malaysia's position in the economic chain. So we are an export economy. We are heavily dependent on global ties, global chains, and all that. So by not adhering to this, we'd probably be shooting ourselves in the foot. And the same thing goes for many other countries. It's not just Malaysia. Many other countries would have the same problem.
Yeah, no, absolutely. So it has become a global change. It has created a lot of opportunities, really, for different jurisdictions. I wanted to talk a little bit more about this overarching space before we go into specifics. And what I wanted to talk about really and ask both your opinions is about BEPS 2.0. So, the market itself and businesses generally are grappling with BEPS. Jurisdictions are grappling with BEPS and the whole substance requirement. And now we have BEPS 2.0, and we have this whole idea of digital taxation. So, how do you see, before we go into more specific areas vis-a-vis Labuan and Malaysian tax, how do you see BEPS 2.0 and this whole idea of digital tax affecting the global tax landscape? Either one of you.
Yeah, I'll take that question. And to be honest, I think it'd be a lot easier for me to predict the lottery winning number than to actually predict where BEPS 2.0 is going to go. Now, Action Point 1, which came out in 2015, was on the digital economy. And this is simply because the way our economies are changing, digitalization, everything from streaming services, your television services, to music, to how we buy things today. It's changed a lot. We're doing it all online. We are paying by credit cards, bank transfers. And if you want to buy a bag, you no longer go to Labuan Plaza to buy a computer. You can probably buy it online and it's shipped to you from either Malaysia or Indonesia or India or Europe. Personally speaking, I bought some things the other day from a website in the UK, and when I received the items, I realized they were shipped from China. So I paid in pounds, but I got the item from China kind of thing. And maybe I should have gone to China directly to buy it. That's silly of me kind of thing. But these changes has actually upended the taxation system. The tax system has always been built on the premise of bricks and mortars. I want to tax you because you are based in my country. You are here, I will tax you. I can actually determine how much your sales are, what you're selling, and then apply a tax rate to that revenue which you're earning. But the moment you are based in a different jurisdiction and you're earning revenue from my country, I have the difficulty of taxing your revenue because you are not based in my country, leaving aside the concept of a permanent establishment. So as a result of that, the OECD came up with Action Point 1, the digital economy. But at the same time, because it is consensus driven, it became very difficult to reach a conclusion on action point one. So BEPS 2.0 is actually an extension of action point one, where they came up with alternatives, hoping to get more consensus on this. These could be divided into two pillars, pillar one and pillar two. Pillar one looks at allocating the taxing rights for cross-border activities based on a nexus. They want to see what is your connection to that country, how much you're selling there, and then we'll allocate the profits from that to that country which your customer is based in. This would largely apply to digitalized and, let's say, consumer-facing businesses. This would be your streaming platforms, your online sales sites, etc., and all that. Now, pillar two is somewhat wider and therefore a bit more contentious. Pillar two basically says that if you are a company and you are located in a jurisdiction, both the parent and source country, source of that revenue, they can take your income, which is untaxed or taxed at a low rate, and then in a way apply a tax to it. So it's a kind of known as a global anti-base erosion or GLOBE. Now, the danger of this is that it doesn't just apply to digitalized economies, to digitalized businesses, but it can apply to almost every business. So you don't have to be in the digital space. So this is where there's been a lot of pushback on. There is supposed to be a conclusion by the end of this year, sometime in December. I personally do not think we will reach a conclusion. That's my personal opinion on that. If they do reach a conclusion, it'll be interesting to see how it's implemented. I think pillar two would probably be more attractive to many developing countries because they don't just have to look at digital businesses. But I think there will be a lot of pushback from the more developed countries on this. I think this is still a space where it is a KIV kind of space, which we need to look at in the future.
Thank you. So we're grappling with the changes, knowing full well that there'll be more changes coming, knowing full well that the idea, because of the pandemic, a lot of things are going digital anyway. And so presumably there will be a stronger push by governments to want to adopt some kind of a system that's a little bit more all-encompassing, I guess. And the idea, talking about COVID, I wanted to ask Jennifer a little bit about the regulatory relief that is available because of COVID in Labuan, and also the relief. So I think there's a lot of, there's a little bit of maybe confusion about the different types of relief that is available in Labuan, in the sense that there is a COVID relief, and there's also an extension of duration to fulfill substance requirements. Do you want to walk us through the differences? So maybe the audience is a little bit clearer with regards to what is based out of, what is the requirements, what is the relaxation based from the challenges we faced because of COVID, and then that whole substance piece as well.
Yep, I think a lot has actually happened over the past year and a half since the substance requirement was issued on the 1st of January 2019. A lot of, I guess, feedback from a lot of companies was that this all, in terms of grappling with so many things, in terms of substance around the world and all that, so more time was needed, for example, to deal with how many people we need to employ in Labuan and all that sort of stuff. So administratively, even though I would say substance regulation was issued on the 1st of January, administratively, companies in Labuan were actually given the entire year of 2019 to actually find the people. For example, if you need to have 2 people in Labuan, instead of having these people in Labuan by 1st of January, you were actually given time until end of 2019 to find these 2 people. Yeah. And of course, the minimum spending would be for the entire year. So I would say that would be something like an administrative sort of relaxation to meet the substance requirement. Even the substance requirement for holding companies, there have been certain relaxation as well. If you remember, I mentioned just now that there's a difference between holding companies and pure equity holding companies, right? So earlier on, when a substance regulation was issued, the guideline actually says you need to have 2 people in Labuan. And because of feedback, if you're just a holding company, the question is, why do you really need to have two people? So the regulators have actually said, okay, fine, if you're a holding company, then you need to have one person. We'll give you until end of 2019 to meet that requirement. But if you're a pure equity holding company, you don't really need to have anyone there. You just need to have meetings in Labuan, which I think is a very fair sort of like relaxation. It really sort of like recognizes the practical sort of like situations of different types of businesses and companies. So I would say that is more of the relaxation in terms of substance. Now with COVID, it's more to do with the deadlines to file your tax returns, and also how do you meet sort of like control and management and meetings if people can't fly, because international type of environment, you'll find that your board of directors, you could have maybe one Malaysian director, two from Singapore, one from the UK, one from Australia. So how do these people actually come together and meet and have that meeting in Labuan that's required? So I think that's where the COVID relaxation comes in, to say that video conference, for example, will still be okay for this year. Yeah. And the other thing is in terms of filing of tax returns, extension is given until October, for example. So that's more COVID related because in terms of the physical, the not being able to be physically located together, and maybe filing of things. So that's more COVID related relaxation.
Yeah, the thing just to clarify as well is to be clear that the competent authority with regards to taxation in Labuan is the Inland Revenue of Malaysia. Labuan IBFC runs the business of the center, but the taxation rests within the Inland Revenue. So there are two competent authorities that actually in that way manage Labuan IBFC. The other thing to note that's very interesting is that as part of the new substance requirements, well, I shouldn't say new, but as part of the substance requirements, it's overseen by a joint working committee called the Labuan Investment Committee. The Labuan Investment Committee consists of Labuan Financial Services Authority, the Ministry of Finance of Malaysia, and also the Inland Revenue. And what this has created, the LIC has created, is actually a very interesting platform for the industry to come in. The regulators have created an opportunity for the industry to come in and actually air their concerns, talk about practical issues. And that's why what we've seen over the last year and a half is that in certain areas, there has been some changes with regards to the requirements of substance. And that kind of segues nicely into this, into the uniqueness of the Labuan substance approach. We have had a very defined list of activities, a very clear requirements with regards to full-time employees and the kind of spend. Jennifer, do you want to talk us through the uniqueness of this, and also with regards to the spend, what can be credited into the spend, i.e. What can be included as part of that domestic spend in order to meet the substance requirements?
Yeah. So I think you've correctly pointed out about the Labuan Investment Committee, and it's actually great to have the regulators come together and actually meet and discuss about various industry issues. It's good to get that feedback from industry players, and to a certain extent you can see that the LIC, made up of the Ministry of Finance, the Labuan FSA, as well as the authorities, have actually met quite a few times during 2019, as well as some parts of 2020, to discuss about various issues that the industry players have faced and what are some of the requests of the industry players. So that's good to know. And I think if, for example, if a taxpayer is caught in a situation that because of the substance requirement, there's a bit of uncertainty because their industry may not be caught under the 20 plus list of activities, there is always that chance to write in to the Labuan Investment Committee and basically seek some sort of clarification. Yeah, so that ability is there, and I think that's a good type of arrangement because it shows that the regulatory authorities are hearing what the industry players have to say, and give the feedbacks that are given are actually being heard and something is being done. Yeah. So I think that's the good thing. I think your next question in terms of the spend. So you will have businesses that minimum spend is 20,000. For example, that is more for the holding companies. And you have other businesses where the spend could be, say, 3 million for a Labuan commodity trading company, or it could be, say, for example, 200,000 for a bank. So what's included? I think basically whatever operating expenses that the Labuan company will spend within Labuan itself would be included. So it'll be things like, for example, your rental of your offices in Labuan. It would be the salaries of the people that you've employed in Labuan, and all the ancillary types of expenses, like, for example, your electricity bill, your water bill, your telecommunications bill, and all that. So that actually would form part and parcel of that minimum spend. And when you think about it, for example, 20,000 ringgit is really not a lot to be able to achieve, for example. Yeah, it's only 2,500 US dollars. Right? So in that sense, even that requirement to have minimum spending is quite reasonable, I would think.
Yeah, no, absolutely. And that's what I wanted to highlight, is that, when you look at the Gazette order that details out exactly the requirements, and this creates a lot of certainty and clarity, this Gazette order. What happens is two things. Number one, you have to remember that it's in Malaysian ringgit. So that spend is in Malaysian ringgit, number one. Number two, with regards to what constitutes that spend, even the amount that you pay for your license goes towards that spend, right? So if your requirement for a bank, let's say, is, I think, 100,000 ringgit or 200,000 ringgit, the 80,000 ringgit that goes towards the yearly license spend is contributed towards that, goes into that 200,000. So, in that sense, it's very achievable. And that's why we feel that the cost efficiency of Labuan is really coming to the fore. And the clarity that the Gazette order provides, in the sense that these are the requirements, and because these requirements have been endorsed and by the regulators, it's the certainty in meeting your economic substance obligations. There is, however, Jennifer, I wanted to go back a little bit to this idea of 24%, okay? Because historically, Labuan had a interesting tax regime where you could make currently even, you could make an irrevocable election to be taxed under the Malaysian Tax Act at 24%. Since then, there's been changes to the Labuan Tax Act that indicate that 24% will also kick in for Labuan entities that don't meet the substance requirements. So what you have is, and the way we like to look at it, is two things. Number one, you have your Labuan corporate entity, and then you have your Labuan tax scheme. You can keep your Labuan corporate entity and have a Malaysian tax scheme, i.e. your irrevocable election to pay 24%, or you can have a Labuan corporate entity, not meet your substance requirements, and pay that 24%. Now, my question to you, and I think a lot of the questions coming in, is the latter 24%, that is not irrevocable, right?
That's right. So you correctly highlighted that there is also this flexibility that some Labuan companies may say that I don't want to be taxed under the Labuan tax system, which is the Lomata. Yeah, and that's because I may, for example, want to be taxed like a normal Malaysian company, because maybe I want to access some tax treaties, and some tax treaties may say that I don't recognize a preferential regime like what you have in Labuan. So companies can actually choose to elect to be taxed under our domestic income tax system, which is the Income Tax Act 1967, and that sort of election is irrevocable. In other words, once the Labuan company chooses to be taxed under the domestic tax system, and it's mainly done, I would say, is for treaty reasons in most cases, then that's it. You're taxed under the domestic system, and you can't sort of like say, I want to go back to Labuan preferential tax treatment. But on the other hand, if let's say you choose to be under the Labuan regime, which is the Labuan Business Activity Tax Act 1990, that requires you to have substance, right? And if you have substance, you'll be taxed at 3%. But if you didn't meet your substance, then it's sort of like a penalty tax rate of 24% based on the Labuan rules. Yeah, and that is not election. That has got nothing to do with whether it's revocable or not revocable. That is basically something like a higher rate because you didn't achieve the substance, right? So maybe you didn't achieve the substance this year, you're taxed at 24% under the LOBATA, the Labuan Business Activity Tax Act. But next year, maybe you achieve the substance and you go back to being taxed at 3%.
Okay.
Yeah, so that's how it works.
Yeah, so you're not completely out of the regime. You're just in a way penalized in that sense, I guess. But there are very unique structures and corporate entities within Labuan, within the legislation that Labuan offers, which makes it very palatable still. I wanted to go back to Bindo a little bit because he's looking a little bit lonely. And I wanted to actually ask Bindo about, I think sometimes when we are focused on a specific jurisdiction, it can feel like a storm in a teacup. It can feel like, this is the worst thing ever. It's horrible. But actually, all jurisdictions are going through the same growing pains, as it were. And I wanted to just ask you, do you know what other regulatory authorities in other financial centers, how they are dealing with this substance challenge? And, example of issues that they're having and things like that. Do you have any sharing that you'd like to give us?
Yeah. I believe that Labuan is not unique in this storm in the teacup, as you mentioned, kind of thing. I think this storm has hit almost every financial center. As I mentioned earlier during my presentation, Hong Kong, Bermuda, Cayman Islands, Cyprus, they all have had to change their legislation to accommodate for this. For the simple reason is that not changing their legislation would actually be detrimental to them. And businesses themselves would also look at it in terms that if I'm located in a jurisdiction which has not implemented these changes, would I be able to, in a way, not be penalized by my home country's tax authority or the tax authority of another country where I actually have major business in? These changes have had to happen. Now, as far as the tax authorities, there's some tax authorities that I've seen, for example, like Bermuda, etc., and all that. They actually have also had to change in relation to the EU because the EU also came up with the harmful tax conduct, basically. And these changes had to be implemented. And their core business activity requirement, I think they've got the same challenges as Labuan in terms of dealing with it. I think, personally speaking, I think Labuan was a bit ahead of some of these jurisdictions in coming up with, I would say, more clarity and more precise terms for which businesses need to adhere to. Some of these other jurisdictions are still a little bit vague when they say that, when they talk about a certain activity or a certain type of substance, they talk about you need to have an adequate number of employees, for example. There's always a debate on what's an adequate number of employees. I think the OECD had that term, the man and the dog. What's the role of the man in the company and what's the role of the dog in the company? Is the man's role to look after the dog, or is the dog just merely the pet of the man? So these issues will happen. I think Labuan, by having a more precise definition in its legislation, has probably done a service for many of the Labuan entities because it tells them that, okay, this is what you need to do in order to meet our definition.
Yeah, absolutely. There's clarity. And you know what? In the first 6 months of the year, we can see growth. Growth in banking, growth in insurance, and we're very pleased. Having said that, I'll be the first to admit that there is still a lot of issues with regards to certain unlisted entities within the Gazette order. And that is something that I know for a fact the regulators are working on together with the LIC and the MOF on trying to figure out how we move forward with this. So, I'm not going to sit here and tell you that everything is signed, sealed, delivered, nicely packaged. That's just not me. But yes, there are challenges, but the clarity allows for certainty in business. And I think that's important. So if you look at the Gazette order, that's listed all the licenses, all the license categories are there, and that creates certainty. And I think, as you say rightly, Bindo, it is a little bit forward thinking. The issue of adequate and what is adequate, how long is a piece of string? A lot of the other jurisdictions have taken this approach. And I think, to be honest, with all due respect to them, I think it's a little bit like kicking the can down the road. The issue will come eventually. That will not happen in Labuan because of that clarity. So I wanted to just ask the admin, because actually we've run over. I think we could have done a little bit more, but I wanted to ask the admin to pull out the results from our 2 polls earlier. So that should be with you soon. And the first poll, okay, so it's coming out now. Do you believe the global tax landscape will evolve? 83%. So really, definitely it will evolve. And some people say it's about time, because a lot of what was going on in tax had been going on for 30, 50 years without any changes, without any reference to the changing business landscape. So the second one I'm more interested in for obvious reasons. So can we pull out the results for the second one now, please? Close, but still okay. So apparently, Labuan should be able to enhance our competitiveness by in the next few years, but clearly there is a lot more work to be done, and we recognize that. We recognize there's work to be done. We recognize that we need to do it quick, and we appreciate the goodwill and everyone here listening in. We have had a lot of questions coming through. I think we've tried to cater to most of the questions that we can answer. So what we will do with the rest of the questions is come back to you specifically on the areas that you've requested. So for example, there was a question on whether airfares can be taken into the spend and things like that. And the answer, I think, is yes. But we will definitely come back to you personally on a one-on-one based on all the questions that you've asked. So there's not much left for me to do but to thank everyone for being here. Thank you, Bindo. Thank you, Jennifer. Thank you for taking the time. We really appreciate it. And thank you, all of you, for listening in. We hope we've been able to clarify certain things and given you a general overview. Please don't hesitate to contact us for any further information or any queries you may have. Thank you very much and have a lovely evening and rest of the day.